Okay, hello everybody. Welcome to Korean Atlanta Mentorship. So we're going to do a quick review with Velocity Banking as to why the bank probably doesn't want you to use the Heloc in the way that you would with Velocity Banking. So take a look at US Bank's website. And here it says how to use your home equity to finance home improvements. And why would they want you to encourage you to use your home equity to make big purchases with home improvements? So let's go here. And I have this little phrase here is to understand finance, you must think like a lender and pretty much not as a consumer, right? So imagine that you were lending people money to them. Now, first question, would you want them to pay you off quickly, right? Like, let's say, something like a 30-year mortgage. I don't know if you've ever seen how much interest a bank collects from a 30-year mortgage, but even from a 3% interest rate, they actually make 50% in total. And then 6%, it's like 112, and then 9 is around 200%. And if you don't believe me, just go to bankrate.com, loan amortization, right? Just type that in. They got a calculator, and if I just do $100,000, 30 years at 6%, look at how much interest I am collecting, right? About 115%. And so if you pay this off early, let's say it's that 10-year amortization, you make only 33,000 compared to the or 33% compared to the 115% interest, right? And so um, so here's the thing: if I'm going to put myself in the bank's perspective, um, and I want to maximize interest, one of the ways that we maximize interest is make sure that we only collect minimum payments, right? If you make more than the minimum payment, that actually doesn't make you more money because you want to collect the interest, and the interest is calculated off of the balance of what you have lent, right? And so if I take a look here at US Bank's website, I'm taking a look at this, it's like, home improvements, those might cost a lot. And so I'm thinking, what's the best way I can make the most money? Let's encourage people to make big purchases with minimum payments and then we'll profit, right? So remodeling a home, that's going to cost a lot of money. And if you're like the average person, you're just going to make minimum payments. And then we also encourage you to have a savings account. That's how I imagine what the bank's plan is. And I've never worked at a bank, so I don't know if they exactly think like this, but I'm assuming this must be how they would want society to be conditioned. And so here's the thing: when we do velocity banking, we're going to do the opposite of what this master plan here would be, which is collecting minimum payments. We're certainly not going to pay minimum payments to our home equity line of credit. And we're certainly not going to do this. We're not going to have anything in our savings account. Now, we could make some big purchases, but we're going to get rid of the minimum payments because we don't want the bank to collect as much interest as they do. So let's do the opposite of that, right? We don't need to do that. So here's the thing: we're gonna do velocity banking with the HELOC. So we have a HELOC right here. Now, if you're the average American, right? How's the average American do things? We may have multiple debts and we try to make minimum payments on all of our debts, right? Credit card one, credit card two, HELOC, auto loan, mortgage, and then we have our general expenses, and then whatever we have left over we just put in our savings account because that's what we're told. Oh my goodness, like Dave Ramsey says, you should have $1,000 in your savings account as an emergency fund. But here's the thing: why not just maximize our cash flow and have zero savings and throw all of our money into our home equity line of credit, right? Because that's essentially what velocity banking is. We're gonna throw all of our money and we're gonna assume we have the same income into this home equity line of credit. And guess what happens when we throw all of our money into the home equity line of credit and make it as our main operating account, right? So, what's the difference between the average American and the velocity banker? The average American's main operating account is that checking account, right? You pay for things in your checking account and you want the rest in their savings. Whereas with the velocity banker, you're dumping all of your money into one place and you're going to have zero savings, right? So I don't know about you, but if somebody did this to me, I think I'd be pissed because they would be minimizing the interest payments. Okay, so let's go ahead and do this. Go ahead and copy this here. And so as you can see right here, we have the same cash flow as we have in savings, right? But when we do velocity banking, we're going to have zero savings. And this is what we're going to do. We're going to put our entire paycheck, so let's go ahead and highlight this right here, into our home equity line of credit as our main operating account. So we got a $20,000 home equity line of credit at 10% interest rate, and we'll just assume it has a $25,000 limit. But this is going to be our main operating account, okay? So what happens when we dump this entire $5,000 into that, I'm sorry, this is a $20,000 balance, into that home equity line of credit? Does the minimum payment matter? Not really. We're going to calculate the interest, but the payment itself, bam, it's gone. It's gone. So you notice how this went from 801 savings to $1,168.40 in cash flow. Okay? So let's go ahead and do that. And then what we're going to do is calculate the next month's balance and the next month's interest, right? Or I'm sorry, yeah, next month's balance was next month's calculation of interest. So to get the next month's balance, it's the previous month's balance plus the previous month's interest minus what we call our cash flow. So 1168.4, right? And then we need to calculate the interest, which is based on the average daily balance multiplied by the interest rate and then divide by 12. So we'll just assume a 10% interest rate. And then all we got to do is rinse and repeat, right? So let's take a look at our document of what we're not doing, right? We're doing the opposite of what most people are trained to do, which is we're not going to make minimum payments into our Heloc, right? We're going to dump our entire paycheck into the Heloc, and we're going to have zero in our savings account. Now, if you're like my dad, once upon a time, my dad got a Heloc and he was just making the minimum payments and it was interest only. And he could not understand why, whenever he made a payment, the balance of the Heloc never went down and he like freaked out, right? But even if it's not interest only, again, it's just like a credit card payment where, yeah, most of it will be interest and a little tiny bit will be principal, but because you need the savings, you got to feel comfortable with it, so you're not going to really make more than minimum payments, right? That's certainly what the average person does with their Heloc. They make a big purchase, and then they make these little itty-bitty payments over time, and they freak out, and they write a Reddit post about what's going on. Now, we're going to do pretty much the same thing with a little tweak with velocity banking, where we have this Heloc, and it's going to be our main operating account, and whatever we make as our main operating account, this payment is essentially zero, right? And now all we got to do is just kind of copy and paste. And this is what I actually would do in real life. I would move as much of this credit card debt as possible into that line of credit and fill it up. Actually, let's do this. Is there a point, maybe here I could move it to $7,000. 7,000,000. Okay. Let's do it in the next one. So realistically, I would make this credit card, or I'm sorry, line of credit, be at 25,000, especially if I have a credit card debt. So I'd be like transferring pieces of the credit card debt as much as possible to that line of credit. But it's a little bit hard to show. But I'm just here to demonstrate the concept. So when we transfer the $7,000 into the line of credit, guess what happens? Oh my goodness, this turns to zero, right? So now our cash flow is 1407. So now after this, I just got to change this from 1168.84 to 1407.57, right? And then we just rinse and repeat over and over again. And here, the balance of this will actually go down, and our cash flow will minimally go up with every single payment. But we're gonna not do that calculation for now because I don't want to be here the whole day. But let's just assume that scroll down. Okay, so we're at a point where we can transfer 10,000 at this stage. Would it be 10,000? Probably not, but let's just assume that it is $10,000. So let's go ahead and add this here, transfer this $10,000 to our line of credit, and then we're going to free up this 325 in cash flow. Although at this point it's probably going to be a little bit less because your cash flow will increase with every minimum credit card payment. But let's go ahead and do this. So we're going to add 10,000,000, okay? And then guess what? This turns to 0. Oh my goodness. Now we went from 801 to 1732.57. Isn't that amazing? Like, we just keep increasing this cash flow number, have 0 savings, and do the opposite of what most Americans are trying to do, which is have a savings account and just keep making those minimum payments on your loans, credit cards, debts. What we're trying to do is just make sure that we are able to throw our entire income into one place, right? And we're preventing something called segregation of income. All right, so let's go ahead and keep doing that. So now let's go ahead and highlight this, okay? And what we're going to do is now put in our new cash flow of 732.57, right? And then just keep going until this sucker goes to 0, okay? And then now we see at 26 months, and this is probably a little bit over exaggerated. It's probably going to be a few months before all of our credit card debts and our Heloc, which we did not use as our main operating account when working as the average American, is it has been paid off, right? So these 2 credit cards in the Heloc. So how long did that take? A little bit around the 2-year mark. We'll just keep, this is an estimate, but we'll say 26 months. So 26 months for 37K, okay? 37K to pay off these 3 debts. Oh my goodness, look how easy that was. Now we got to take on the auto loan or the mortgage. So if you want to know which debts do you tackle or pay off, we have 2 debt criteria figuring out which debts to pay off. So you want to figure out like which one has the lowest balance, highest interest rate, and highest payment, or you can use a cash flow index, right? So this one has the lowest balance, but this one has the highest interest rate and the highest payment. But I would rather take away the auto loan first because it's going to give me more bang for my buck with regards to cash flow. And if hold on, let's actually do this. Let's figure out the current balance of this auto loan after 26 months. So we can just go ahead and put that right here. And then we'll just go to the loan amortization calculator, right? Loan amortization calculator. And then we're going to put in $20,000, 20000 for about 5 years at 4%, okay? And then we're going to figure out after month 26 what the current payment is. So month 26, or the current balance. All right. So about 11 grand. Now, if you want to calculate this cash flow indexing, and I'm kind of going fast, but it's because I'm a little bit sleepy right now. You take the statement balance and then you divide by the monthly payment. So equals 11,821.06 divided by 368.33. And if it's lower than 50, you definitely want to pay it off. So basically, I pay this 11 grand, I'm getting $368 back. If I pay this, it's probably 195 or 196. If I pay this off, I'm getting $1,200 back. Which one gives you more bang for your buck? It's this one, just because you pay so much less to get a sizable payment. So it's all about the payment to loan balance ratio. So one of the things I can do here is I could just move this into a line of credit. Let's go ahead and move it. And then guess what happens here, right? Guess what happens here? Oh my goodness, this goes to 0, right? So this goes to 0. And what's our new cash flow? 2100.9. So now we just do the same thing with 2100.9. We just simply change this cash flow to our new cash flow number, right? And then now at 32 months, we paid off the car. So 32 months, how much was that? That was plus 20K, so it's 57K. Wow, that was easy. That was so easy. I paid off the car pretty good. Now the next thing is the mortgage, right? So with this 2100, you have two choices. You could either pay the mortgage directly with the 2100, or you could just transfer pieces of the loan to the line of credit. And you might ask, like, what's the benefit to using a line of credit that's at a higher interest rate? And here's the main benefit for me. If I dump this entire thing into that mortgage, yes, it will save a ton of interest, right? But the problem is, let's say I have an emergency. I don't know the exact amount. If I do have an emergency, or if I do have to budget for certain months of how much should go directly into the mortgage. So what I'd rather do is just transfer, make it easy for me and transfer some of the principal to the line of credit and then just pay it off with my cash flow. It's much easier because you don't have to be exact, but it's almost the same result, right? So let me go ahead and let's figure out 32 months what the loan amount balance is. So 20000 at 30 years at 6%. And what is the balance at 32 months? It's 193. Okay, so let's go ahead and do this. So the idea is that you're going to transfer about 5,000, and I think the rule of thumb is you just transfer the same amount as your income into the line of credit. So what's 193 minus 5? It's 180. It's 88. I think it's 88, right? And then you pay it off, and then you transfer another 5, and then it's 183, and so on and so forth, right? So just to kind of give a quick demonstration, so let's say that we're at 193. How long is it going to take for us to get to 188 if we just followed the bank's plan, which is just minimum payments, collecting minimum payments here? So 193 minus 5 is 180, 188. Did I put that right? Hold on, 188. 188, right? So how long is it going to take me to go from 193 to 188? So 1, 2, 3, 4 months, and then a year, and then so about 5 months, right? It's going to take me five. I'm sorry, not five. What am I saying? 1 year and 5 months. That's what I was going to say. 1 year and 5 months. So now, if I do this and just transfer this into the line of credit, so let's say plus 5000, right? And then look how long it takes to pay it off. 2 months versus 1 year and 5 months, right? Is that crazy? Now here's the thing: there's a little bit nuances because this is like the poor man's way of doing what we call chunky, of just transferring pieces of the line of credit into I'm sorry, the mortgage into the line of credit. But the most important thing is this cash flow number. And, I go into other videos why the mortgage is paid off last. But we want to make sure when we tackle the mortgage, this cash flow number is at its maximum and all of our other debts have been paid off. Okay. Now, luckily, we have this velocity banking calculator that will pretty much do all the work for you, and including taking into account the payment. So let's go ahead and just fill this in really quickly. And okay, so let's go ahead and copy and paste this. And if you don't know where this calculator came from, it's actually where I first learned velocity banking from Renatus. You could just take a Google search of Renatus velocity banking. And I'm actually a third-party reseller, independent contractor, marketer for Renatus products, meaning I make a slightly itty-bitty commission based on the, well, not slightly, based on the products that I sell, but I am a reseller of these products. Now, let's go here. 5,000 is the amount that we're moving to the line of credit, 10% interest rate. And here our expenses are just everything except for the loan we're trying to pay off. So the only other expenses are general expenses. If we take a look here, oh my goodness, it only takes us about 6 years to pay this off. A little bit under 6, right? So now what we do is 5.9 years. So equals 32 divided by 12 plus 5.9, right? So 8.57 years, 57 years, not tiers, years, debt free, right? Debt free. And we paid off $257,000 of debt. That was really easy, right? In fact, I'm pretty sure soon I'm going to get to that Bruce Lee status because if I make 10,000 videos, remember, there's that Bruce Lee saying that I don't fear the man who does one one type of kick 10,000 times, or am I saying it right? I don't fear the man who does 10,000 kicks one time. I fear the man who does one kick 10,000 times, right? And that's what I'm doing here. And that's why I'm so crazy good at this, or at least I think I am, where I just do the same situation over and over again. And it's the same with fixing flipping houses or wholesaling or whatever real estate strategy. You just do it over and over again and you gain an intuition about the numbers, right? I always gain an intuition about velocity banking. And if someone tells me that if they're doing velocity banking, it's going to take them 10 years just to pay off the mortgage, they must have a really poor cash flow situation. That's what I think, because you'll notice that this 8.57 years took into account all of this, the credit cards, Heloc, auto loan, and the mortgage, not just the mortgage, right? It's not pay off your mortgage in 8.57 years. It's pay off everything, the $257,000 of debt in about 8.57 years in the simulation. All right. Well, that's it for today. Have a great day, everybody. This is Korean Atlanta Mentorship, and we will speak next time.